Welcome to Show Me the Money by Michael.derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, leasing, investment brokerage, all facets of the trade. What we're trying to do is kind of have an interaction with them so that you can understand and apply it to your business if you're whether trying to get into real estate or perfect some things in real estate or just learn some tricks of the trade. That's what really the podcast is about. In this first episode of Show Me the Money, we have Hoeven here, who's going to be touching base on self-storage properties, apartments, and industrial facilities across the United States. So we're very excited to hear his management style, what things have been successful, what things maybe have not been as successful, what his take is on interest rates and how the capital markets are going to be affecting and potentially not affecting his business. And we look forward to hearing his insight. Hopefully you benefit from this and helps you in your business, or potentially if you do want to get into this side of it, you can benefit from this. Enjoy the episode. Thank you. Our first guest here on Show Me the Money is Hoeven. Drew, thank you so much for being here. Really appreciate you taking the time.
Yeah, thanks for having me.
Hoeven has 20 years of real estate experience in self-storage, including acquisitions, dispositions, development, construction, and operations. He currently is chairman and CIO of Westport Properties and U.S. Storage Centers. Westport Properties and U.S. Storage Centers were founded in 1985 and 1998, respectively, by Barry Hoeven, Drew's father, and specialize in storage, multifamily, and industrial properties. With a combined experience of over 100 years in real estate, the USSC family has grown to currently operate over 180 facilities, totaling 12 million square feet in over 18 states. Westport employs over 500 people nationwide and generates revenues exceeding $230 million a year. Very impressive. Drew graduated from the University of Southern California. Go Trojans. He is a member of the SSA, past chair of CSSA, USC Luss Center for Real Estate, a member of YPO, and NIOP Forum member. Drew is a licensed broker in the state of California and currently lives in Newport Beach with his wife, Jamie, and 3 children. Again, Drew, thank you again for coming.
Absolutely.
Let's just jump right into it.
Let's go.
How has the last year been for you and your team at Westport, given the current landscape and everything that's going on in our world that we live in here?
Generally speaking, we've had a pretty solid year operationally. Obviously, now dealing with the headwinds, things are starting to decelerate. But as far as Q1 was concerned, our year-over-year NOI growth was nearing 23%. Q2 year-over-year NOI growth was around 19.5%. And looking back at Q3, we were about 14% year-over-year growth. So generally speaking, you look back in history and you'd be pretty happy with those with those increases. Looking at storage trending over the last 20 years, I'd say the average has been about 4% growth year over year. So we are extremely excited about what the team has been able to accomplish over the last year. But that being said, we are seeing things decelerate quite substantially. The winter season is our off season. We are very much a seasonal business. So we are starting to see delinquencies go up, net rentals to the negative, and we're seeing a lot less move-ins to date. And then switching over to the acquisition side, the team has done a fantastic job being able to close on 15 self-storage properties, exceeding about $200 million this year.
Wow.
The industrial team, we've been able to sell 2 land deals and flip out of those, all the while closing on 5 others that we hope to start construction on next year. Excellent. And then on the multi side, it's been a little slower. We've closed on 2 deals this year, and actually with our good friend Tyler, hope to close another one, knock on wood, by Friday, I believe.
That's great. Yes, and I'm also an investor with you on the deals as well. So thank you again. It's been excellent. So Drew, leading into that, talking about headwinds, what are you seeing as far as interest rates go, and then as far as investments for multifamily and storage? You're saying it's slowing down a little bit, but really for 2023 and 24 as a futuristic look, where do you see the opportunities here? And maybe do you foresee the Fed reversing course at all, or do you foresee them continuing to increase interest rates and also pulling back, obviously, on the amount of capital they're putting out there for the Treasury?
Yeah, clearly don't have a crystal ball, but the current landscape is pretty difficult. With the Fed, currently increasing every quarter, it's becoming more and more volatile. I would say, we've been blessed to have great institutional partners where we've been able to execute all cash on our most recent acquisitions,
which is huge.
But we do have a lot of refis coming down the pike, and we have financed quite a few deals over the course of the last, call it 6 months.
Right.
And depending on whether we're going out for construction debt, bridge debt, or perm, we are seeing spreads dependent anywhere from 2.25% up to 3%. So on perm deals, call it 6%.
Right.
Bridge debt has been a little lower, and our goal moving forward is to refi with bridge in hopes that in 24 and 25 the Fed does start bringing interest rates back down.
You are forecasting that the Fed will reverse course, things will settle down, and then you can put on perm debt the next, say, 12 to 24 months. That's your take.
We're cautiously optimistic.
Okay, good. Yeah, I think
we're
that's
hopeful.
Right.
So listen to all the other experts out there.
Right.
That's how we see the future.
Of course, yeah. And obviously with the Fed raising rates 4 times this year by 75 basis points has had a huge impact on the market. And so tightening the balance sheet by, $90 billion a month, 4 Fed increases with another one coming here in a few days, I think it's going to be really take an impact on everything. Next year, they're going to probably continue to ramp up the increases depending on what happens with inflation. We also have a supply constrained market that's obviously affecting everyone here in real estate. So with that being said, how are you underwriting deals now? How are you looking at that? If you're underwriting on a bridge scenario right now, what are you forecasting as far as income growth and then also expense growth as well to offset these measures, what's happening in the market right now? Because obviously we all know that payroll costs are going up, the cost of labor is increasing, insurance costs, and the cost of everything is increasing. So obviously, who does it get passed down to?
Ultimately, our tenants, unfortunately. We have seen costs probably go up as much as 20% depending on the line item. We've been hit pretty hard just from the tax side of the business, whether it be property taxes or just state legislatures passing things through. We've also seen, insurance, whether it be healthcare or P&L, property and liability insurance, skyrocket. So it's been some are pretty hard to manage just because they are uncontrollable. And then with inflation in place, we've had to, definitely keep our employees at market rates. So we've done a good job of increasing their wages on a quarterly basis, and then also through COVID, just applying spot bonuses to keep our employer base happy and able to survive in today's environment.
Sure. And so obviously, a lot of our clients we're dealing with right now are having trouble keeping employees across the board because obviously the government benefits sometimes offset the ability for someone, making the same amount of money to stay home versus actually go to work is a pretty big challenge that we're seeing across the board in the market. So there's a lot of headwinds here, but obviously your company on the growth that you've had over the last year has been very impressive. So you've been obviously able to manage that, which is incredible. And so, as far as your own equity, which you have your own equity in the deals and that of your investors, what are the goals that you're looking to achieve on that as a go-forward basis? Have you pulled back the numbers that you're looking to, say, hey, Mr. Investor or myself, I don't think we're going to achieve X amount because the cost of capital has gone up, because maybe this is a supply-constrained market, because the cost of our expenses have gone up, and we can only pass so much on to the consumer, the tenant at the end of the day. Have you pulled those rate of returns back?
Yes and no. So our expectations are in line that, it's going to be a much slower year coming forward. But that being said, we've been extremely blessed to have great capital partners where we're able to execute all cash.
Right.
So that's given us an extreme advantage in comparison to all the other buyers out there.
Right.
And that buyer pool has definitely shrunk. The opportunities have shrunk as well, so there's less deal flow on the market.
Sure.
But that all being said, we do have the capability to just do what the market will allow us to do.
Sure.
And when I say that, we don't have a capital deck right behind us that forces us to put money out. So we don't necessarily have a gun to our head, and that's when we see a lot of bad deals being made.
Right. Yes. And usually happens with syndications with other people's money. When it's not your own money in the deal, we see some clients out there jumping on deals that maybe because the money will be pulled back out of that capital contribution. It's nice that you and your company do not have that. And so that's great. And obviously your investors have been with you so long, they trust you and they know that you're not going to shove them in a deal just because you need to make some fees, which is great.
Right. That or, a lot of fund managers out there have a, 3 to 5 year window to put capital out. So they're forced to get that capital out, which could force bad deals in bad markets. So.
Yes. And obviously, given the dislocation of cap rates versus interest rates today, I mean, it's got to be at least 100, 150 basis points spread on it on the opposite, where just, 2-3 years ago, it was the opposite way, where obviously the cap rates were higher than interest rates when interest rates were down in the 3.5% range for great quality deals, and cap rates were between 4 and 5%. But now it's inverted and we have an issue. And so it's great that you can take advantage of these deals on a cash basis because most people can't. But given your company is so well seasoned and obviously it's got great tenure, you've been able to execute at a very high level and will continue to do so in this market.
So, we hope so. Yeah. We hope so. But we've definitely seen values come down anywhere from 10 to 20%, depending on the specific deal, submarket, quality, et cetera.
Okay. From the peak.
From the peak.
Got it. Okay. So maybe why don't we just kind of transition right into that? So 10 to 20% down, what markets, obviously you're probably looking at a flight to quality now. You're probably looking to go after deals in a very strong submarket, good tenant base, good fundamentals operations, or would you still go after a deal that's kind of outside the main and main location? What's the kind of that?
No, I would agree with you. Flight to quality is real. And we're certainly doing that ourselves. I would also add that a lot of the major institutions or big pension endowments, what have you, they're over allocated right now in real estate. So a lot of those LPs or buyers are definitely more concentrated on smaller check sizes at this point, where the bigger check sizes 6 months ago were more attractive.
Okay.
So we're seeing more opportunity in the big check size as opposed to the smaller check size.
Got it.
We recently won a deal here locally in Southern California, and there was a buyer pool of probably 18 people, and 14 of them came in at ask. Whereas and that was called a $15 to $20 million deal. And, we're also seeing a portfolio on the market in the $100 million range. They had one buyer, they fell out, and there's no offers currently on the table. And those are both core Southern California Class A assets.
Okay, and that first one that you had you said there was 18 buyers on the table. Why did they choose you? What made it so compelling?
Reputation and relationships.
Got it. Okay.
And our track record with execution.
And maybe paying cash too.
That as well.
That's huge. If you eliminate the debt, which obviously I do debt for a living day in and day out, it's challenging right now, but the level of execution, what we do when we go to market now for clients, historically we've been going to anywhere from 10 to 15 lenders. Today we go to anywhere between 40 and 50 lenders on a given deal.
It's insane.
Yes, it's unbelievable. So we're working 4 to 5 times as hard to make sure the client's covered, and we're always thinking about 2 or 3 backup scenarios for that client in the event that lender pulls out of the deal. So the relationships are great, but at the end of the day, you always have to have insurance for the clients to make sure they're taken care of.
Absolutely.
Yeah,
absolutely.
One other thing too is talking about, a team of 500 employees across the country. I mean, how is that to manage? And are you looking to, obviously you have to continue to grow that as you buy more and more properties. What are some of we talked about the costs related to it, but how do you manage that, and what's the style at the end of the day that you really want to, have yourself perceived at the end of the day?
Yeah, well, I think we have a great culture, and our tenure is long. And I give a lot of credit to our senior leadership team. We've all been working together for well over a decade. Charles Byerly,
yes.
Scott Wynn, Peter Watson, Mike Brady, who leads majority of the employee base on the operational side of the business, Jason Lopez on the marketing end. So
okay.
I have this great team in place. And, from the top down, starting with Charles and myself, we give a ton of autonomy to the team.
Right.
And that has allowed them to flourish and manage how they see fit. And it's been successful for us.
Great. obviously, and your investors obviously have seen that, or obviously continued to invest with you over the years, and the track record obviously speaks for itself, which is excellent. Can you share like one particular deal maybe that you did last year, 18 months, that was a great success story, and why was it a success story? And then as a follow-up question to that, I'd like to hear maybe a deal that didn't go so great.
Sure. They happen. Yeah, we're not perfect. We don't bat 1,000, but I think we've done a good job of keeping our nose clean over the course of the last 35 plus years. Fortunately, never having to give keys back, so to speak, to the bank. So, that being said, we've had our moments of troubled assets. Building through the GFC, we had a couple developments where we had capital calls on, and we honored those. But most recently, I'll give you an example of a storage deal, multi-deal, and an industrial deal that we've done recently.
Great.
And for what it's worth, we are generally long-term holders, so we don't recycle deals very often. But on the storage side, we developed 3 deals in Miami back in, I want to say 14 to 15, which were probably a couple of the last storage deals we exited.
Right.
But we finished development between those 2 years on these 3, and we exited at about a 4x and about an 80 IRR.
Wow.
In about a year's time, and each of those assets were either in lease up or sold at CO.
Okay.
So that was a big win for us and the team. We were sad to see those go because they're great Class A developments that we worked very hard on.
Sure.
And then most recently on the industrial side, we just sold entitled land down in Oceanside. Our initial business plan was to actually build this thing, but when you get an offer you can't refuse, we had to take a serious look at it. So we were into the land there for in the mid 2s, and then we were just most recently able to exit over $8 million.
Wow!
So it's a good land flip for the team. And then on the multi side, again, the tide was going out heavily. So, obviously the market played a big factor in our returns here. But we acquired a multi-deal in January. I think January of 20, we closed on it. So, you can imagine come March, we were a little scared on what was to come. But, we acquired a deal for about $14.7 million in Phoenix. It was a heavy value add deal. We started turning some of our units, and a year later, we closed just north of $30 million in, I believe it was December of 21.
Okay.
So over the course of, a year and a half or close to 2 years, we were able to achieve about a 3x on our equity, which was a great win.
That's a huge
we were happy to exit that marketplace at that time because, as we all know, Phoenix has been a little frothy.
Yes, Phoenix for sure. We're working on some deals there right now where we're starting to see rent growth as a challenge. I guess flattening is maybe the best case there because there's so many units coming online and there's so much inventory coming, in that space, and how many people can really be moving there in that aspect. But I think long term, obviously the market's going to be great in the Sun Belt, all those areas. But realistically, how much more growth can there be? And the cap rates, obviously have to go up across the board.
Right.
And so one thing you talked about is the construction and development that you're working on deals. Are you seeing construction costs on the rise, or are you seeing them flatten, or are you starting to see them decline? I know obviously a lot of this correlates to the price of oil and the price of lumber and everything, and obviously labor costs too.
Yep. Supply chain.
Yeah, exactly. Supply chain.
No, good question. Thankfully, we're finally starting to see it plateau, specifically in the self-storage business.
Okay.
So it's plateaued, and we're hoping come Q2, Q3 of next year, that'll start coming down. And then on the industrial side, just speaking to my peers most recently as of 2 days ago, this past Friday, we're hearing an 8 to 9% drop in costs.
Great.
Specifically in Phoenix in particular.
Sure.
And we have, 4 or 5 developments that we're starting early next year. So we're hopeful that we'll see a drop in those costs, to the tune of 8 to 9%.
Great. That's terrific. And then going back to the one deal I didn't, we didn't touch on, and I think the audience would like to hear it, and not to put you on the spot, but we're putting you on the spot. Has there been a deal over the years that maybe didn't go as well?
Wish we didn't do it?
Yeah. Maybe, Yeah, maybe if the best deal you didn't do, either that or a deal that you did buy and be like, oh boy, why did we get into this? I didn't realize or foresee that coming.
Right.
Maybe the government intervention, right? Like, like the taxes, like
totally.
Real estate.
And there's a few examples just like that.
Yes.
I think there's hundreds of deals we're happy we didn't do, but there's also thousands I wish I did, right?
Sure.
But that all being said, a few come to mind. We acquired a portfolio in Texas, I want to say back in 2016. And
storage portfolio.
Self-storage portfolio,
okay.
Correct. We got in at a good basis. It was a great heavy value add portfolio opportunity. But what we didn't foresee, being that Texas is a non-disclosure state, so therefore they don't know what we paid for these assets.
Right.
Yet fast forward, 5-6 months later, they reassessed our property taxes and the value correlated with that on the portfolio significantly.
Yeah.
And that was a big budget pro forma bust for us.
Okay.
Thankfully, we've been able to operate out of that over the course of COVID. But that was something that we did not foresee, especially after speaking to multiple consultants and our tax attorneys within the state. No one saw it coming.
No one saw it coming.
So it was more of a statewide issue as opposed to lack of underwriting.
Was it a micro, diligence. More of a macro?
Right,
yeah.
Right. But nonetheless, we wish we can take that back. And then there's a couple properties, when you do these value add deals and they're older assets, there's just so many unforeseen things that don't meet the eye.
Right.
And we've had, a couple what I call waterlogged properties. Just flooding issues and pipes bursting because they're in the Northeast and they're freezing.
Right.
So, over the course of time, we've been able to also operate out of those, manage the CapEx, and then those two particular properties we exited.
Okay.
And thankfully, we're still able to get a really good return for our investors.
That's great.
But we knew it was time to exit and focus on more quality assets.
Great. And, a big thing about real estate too, sometimes people hold assets too long. A big thing with real estate is, location, but it's also timing as well. Timing becomes very, very important. Timing the interest rates, timing the cash out opportunity, timing the acquisition, timing when some other development will be coming near your property, eminent domain opportunities. There's so many different things that people just kind of get so held under their real estate and they don't look at the big picture sometimes. So it's great that you guys recognize that. You make a decision, because some people are like, I can just hold this piece of real estate forever and be great. Right. And some pieces of real estate are not great forever. And that's the thing, especially people that run on depreciation schedules, or they can, sell that property and go into a better location long-term. It's amazing how sometimes, emotions come into play versus an investment side of things, removing emotion and just doing it.
You got to take that hat off, because I'd say, generally speaking, we love to own everything in perpetuity forever.
Right.
It's a great cash flow business.
Sure.
And it's done really well for us, but totally agree. Sometimes you got to look at the reality and pull some chips off the table and,
yes,
prune the portfolio, so to speak.
Right. Exactly.
Yeah.
Well, outside of Westport, you're also very heavily involved in Curate. So could you kind of touch on that? And I love the very philanthropic nature that you have and everything. So could you kind of touch on that for our guests and let us know what that's about?
No, I appreciate you bringing that up. It's a huge part of our company culture. It was founded by my father back in 2007 when he was diagnosed with kidney cancer.
Okay.
So it's Curate with a K. And he founded it in conjunction with his oncologist at City of Hope at the time. And initially, Dr. Robert Figlin. Initially, the goal was in joint to raise money for underfunded cancer research. And then, over time, they created a 501c3 and now have granted well over $13 million worldwide,
that's great.
Which is great. And when I say underfunded cancer, the likes that don't get a lot of government grants. So, breast cancer, prostate cancer gets all the attention and money, but all these other smaller cancers that don't affect as big of a population, but, in total, it affects a lot of lives, is who we target.
That's great. Yeah. Well, my hat's off to you for that.
Yeah, and I would add our team has done a fantastic job all the way down at the field level at the properties. So we have programs, one in particular called Roundup for Research, where If one of our tenants will round up their rent by 50 cents, we'll match that.
Oh, that's
so
great.
With well over 100,000 tenants within our portfolio, those individual 50-cent donations and then our additional 50-cent donation adds up relatively quickly, which has been a great driver for raising money.
That's huge.
Yeah,
that's excellent. One last item I would like to just ask, as far as just getting back to Westport, what is that 2023? What are the goals there now? What are you foreseeing as a final concluded kind of answer here to wrap things up?
Yeah, I mean, manage expectations, right? It's not going to be a perfect year. I think we got to play in our lane, and really just do deals that make sense, right? And not get over our skis. And I think we're just going to have to analyze a lot harder. But again, I think we're in a great position as far as our current portfolio performance. We're pretty well under leveraged, and then we do have great capital partners willing to close all cash until sunny days come again, as far as the debt markets are concerned.
Sure.
So we're cautiously optimistic, and we hope to get I think if we do half the volume we did this year, we'd be happy.
Well, that's great.
Yeah.
Well, again, my hat's off to you and your team. They're excellent. I've worked firsthand with them, and it's really impressive. And I wish you continued success. I want to thank you for your time, your insight, your knowledge, the ins and outs of the business. And it's just a pleasure, Drew. So
it's been great working with you too, Michael.
Thank you so much.
Yeah.
Thank you for coming.
Yeah.
And that's it. That's a wrap for our first episode here of Show Me the Money. Thank you.
Thank you.